The next part that we're going to do is government grants. Now, what are government grants? These are kind of how the government wants to help you with certain things. So they give you a lot of grants. Grants is kind of a help or an aid. It's kind of a help or an aid to a business, to an industry. It could be a single business or it could be an entire industry. So to just help them stand on their feet and get better at what they're doing, make better profits, generate more employment, right? So for all those purposes, a government grant is basically given. It could be given to a specific company or to an entire industry, right? So, and how does which standard deals with this? It is IAS 20. So International Accounting Standard 20 deals with the government grants, right? And the IAS 20 also, what it does is it defines what are government grants. So what are government grants? Government grants are transfer of resources to an entity in return for past or future compliance with certain conditions. They exclude assistance that cannot be valued and normal trade with governments, right? So suppose a state government says that, okay, we welcome you with a red carpet, and it gives them assistance, it gives them, smooth licensing procedures and very good land acquisition process. So all that cannot be valued. So government grants as per IAS 20 does not include those things that cannot be valued. But what does it include? It includes the transfer of resources. And what kind of resources could it be? It could be free electricity, or it could be free land, or it could be in terms of your cash as well. So they can transfer cash or some other resource, some asset, some existing. So there are existing factories in a state, and the government wants those factories to become operational. So what it will do is they will grant for a very nominal amount, they could grant those factories to a certain company, that you come and make these factories operational. So it is transfer of resources. Resources could be anything, not just limited to cash. Yes, Samriddhi? Does it make sense? Right? Transfer of resources to an entity. Right? By the government for past, and it will also say that you will stay in this state, you will do business in this state for this certain number of years, 10 years, 20 years. So it could be for past or future compliance. So the government could say that if you've stayed in the state government can say that if you've stayed in the state for the past 10 years, so for all the entities who have been working, who have been operational from the past 10 years, now we announce that we are giving you free electricity. So for a past or future that you are going to set up and going to be for the next 10-15 years, so we are transferring these resources to you. So it could be for a past or future compliance. So it could be for a past or future compliance with certain conditions. So there are going to be certain conditions, with certain conditions, right? Yes, Samriti? Okay. But they exclude. So what are the exclusion from government grants? From the definition of government grant, what is excluded? They exclude what? They exclude any assistance that cannot be valued. So any assistance that cannot be valued, right? So if you cannot value, suppose a smooth procedure to grant you licenses, so that will not form part of a government grant as per IAS 20, right? So government grants are transfer of resources that cannot transfer of resources to an entity for past or future compliance with certain conditions, and they exclude assistance that cannot be valued and normal, and if you're trading with the government and normal trade with government. So what does this mean? What does this mean? Normal trade with government. This means if you are producing goods and the government is buying it, so that is again not government grant, right? So what is not, what is excluded? What is excluded? First of all, suppose smooth procedures, right? Assistance with government officials, right? So all that cannot be valued, whatever any other thing that cannot be valued, right? And what is that? So if you trade with government, if government buys all of, so a lot of places, see, in small industries like cottage industries, what happens is that government buys those things. I told you now, which cannot be valued. Smooth procedures, government gives you smooth procedures, gives you license without any hassle, or assistance with government officials. So you can meet the government official whenever you want. See, normally the government official, the secretaries and the cabinet secretaries and other secretaries or the district magistrate or a person in power, they generally do not meet people. But if government provides you, suppose the prime minister tells those government officials that you have to assist this CEO or this chairman, right? So that cannot be valued, right? And in a lot of industries, especially cottage industries, what happens is that, give me a minute. Right. So for small industries, what government does is it buys all your produce. So that is the trade with government. So in that case also, we will not take it as a government grant, right? So this much is clear. Clear with examples. Example over here would also include cottage industries. They often trade with government, right? Farmers. So most of the time in India, what government does is it buys a lot of food, the food crops that are produced by the farmers. Right. Now that was about government grants. Now what is government assistance? Not talking about what is government it is being recorded, don't worry. Government assistance. So what is government assistance? So it's not a grant, right? It is an action, right? It is an action designed to provide an economic benefit to a specific entity. It does not include indirect help. Suppose the government makes road, makes the infrastructure, develops the infrastructure. Is that government assistance? No. That is kind of indirect assistance, indirect help. So an action. So it is an action to provide economic benefit. And how does this happen? How does this happen? So see, what the government will do, it will buy the land from the farmers at market rate and give it to the businessman for a very nominal price. So that is a government action, right? So government so government so government, what it does is, these are the farmers, it's going to buy their land, they are going to sell their land to the government, and the government in turn sells for nominal price to the business. So this is an action by the government. It is not directly assistance, but it is an actions, right? So it is an action to provide economic benefit. So now what the business gets is, the business gets that piece of land for a very nominal price because the government has already purchased it, right? So it is government action. Basically, it is government action. So government action to provide economic benefit. Clear? Yes. Okay. Now, what does the recognition part say? When do you need to recognize the government grants? So what does the recognition part say? So what does the recognition part say? It says that government grant should not be recognized until the conditions for receipt have been complied with and there is reasonable assurance, not absolute. There is reasonable assurance. So two things. To be recognized, there are two things. Firstly, whatever conditions were there, they have been fulfilled. So all the conditions have been fulfilled. And secondly, there is reasonable assurance that grant will be given. But conditions for receipt have been complied with. So firstly, the conditions, suppose the government wants you to employ 5,000 people, 5,000 workers, and only then you will receive the grant. So conditions, so then only you will only recognize the grant once the conditions have been complied with. Right? So once the conditions have been complied, so only then grant can be recognized. And secondly, there is reasonable assurance. There is reasonable assurance about what? About the receipt of the grant, right? So two things. Firstly, the conditions have been complied with, and secondly, reasonable assurance about the receipt of the grant. So these two things are there for recognition. Now whenever you receive a grant, so will the government give you a grant like that? Okay, you employ these many people, I'll give you cash for nothing. No. The government is going to give you a grant for two purposes. For two purposes. The government will give you a grant for two purposes. What are those two purposes? Can you guess what could be the purpose of a grant? What could be the purpose of the grant? Why would government give you a grant? Yes, if they are constructing a hospital. Welfare of the people, yes. No, but why would government give you a grant? So very basic, from a business point of view. You could do two things. Government specifically says either for expenditure like electricity or for acquisition of an asset. So either you need to do some expenditure, you've got to do some expenditure, or you need to acquire an asset. So these two are the main purposes for which a grant is given to you. Now, what IAS 20 says, that grants should be matched with the expenditure which they are intended to contribute in the statement of profit or loss. So income grants given to subsidize expenditure should be matched to related cost. So if you've been given a grant, so income grant to subsidize an expenditure shall be matched it shall be matched, right? It shall be matched with the related cost. And this also matches with our matching principle. Did we study the principles? We studied the principles of accounting, going concern, accrual, matching principles, right? So this goes with the matching principle. So if you're given an income grant to subsidize an expenditure, that needs to be matched with the cost. So for any non-financial goal, suppose you are given for some non-financial goal, okay, for expenditure, and you could also be given for a non-financial goal, right? So for suppose you want to, the government wants you to create jobs or welfare of the people, but generally the grant is for an expenditure or for acquisition of asset. But suppose there is a non-financial goal, so you need to match. What you need to do is match the income grant. So match the income grant with the cost to achieve the non-financial, to meet the goal, to achieve the goal. So whatever goal is there, you need to match the income grant with that cost. And for acquisition of asset, whatever government gives you the grant, you need to match it. So if it is related to asset, then the international accounting standard says So let's do it separately. This is so grant for acquisition of an asset. So for acquisition of an asset, what does the IAS say? Right. So if it is for the acquisition of an asset, so grants for purchase of non-current asset. This is, I'm reading it out, and then we will just give me a minute. Okay. Yes. So for grants for acquisition of an asset, right? So your IAS says that for recognition, if you want to purchase a non-current asset and government gives you a grant, it should be recognized over the expected useful lives of the related assets. IAS 20 provides two acceptable accounting policies for this. So there are two policies that it provides, right? So grant shall be recognized over the expected useful lives. So if it is for the purchase of an asset, for purchase of asset, grant shall be recognized over the expected useful life of the asset, right? So grant shall be recognized over the expected useful life of the asset, right? So there are two policies. So IAS 20 gives you two policies. So it says what you can do is you can deduct the grant from the cost of the asset, right? So firstly, what you can do is you can deduct the grant from the cost of the asset. Suppose you've spent 1 million and you get a grant of 500,000. So what you do is you deduct from the cost of the asset and depreciate the remaining 5 million. Got it? So that is the first thing that you can do. So that is the first part that you can do. Okay. Secondly, you treat the grant as deferred income and release it to profit or loss over the life of the asset. So what you do is you deduct the grant, you firstly first thing is you deduct it from the cost of the asset and depreciate the net cost. Secondly, what you do is you treat the grant as deferred income, right? You treat it as if I've been given an income that is, and release it to profit. You capitalize that grant as a deferred income and then you release it to profit or loss over the life of the asset. Got it? So firstly, what you can do is deduct the grant from cost of asset and depreciate deduct the grant from cost of the asset and depreciate net cost over useful life. Secondly, you treat the grant as deferred income and release it to P&L over the useful life. So both of these things are going to have the same effect on your P&L. Both these things are going to reduce your depreciation expense. Is it or is it not? Yes or no? Both these things are going to reduce your expenditure and increase the net profit, right? Yes. Got it? So these are the two policies that IAS 20 gives you, right? Now, suppose government gives you a grant, but later wants you to return it, right? So two things can be there in case of repayments. So where repayments are considered, suppose you want to pay the grant, you have to pay the grant back to the government. So repayment, two things you can do. समृद्धि, अभी तक जो बताया वो समझ में आया नहीं है रिगार्डिंग गवर्नमेंट ग्रांट्स? Very good, very good. So repayment. Now, firstly, now again you'll need to bifurcate it between an income based grant and capital based grant, right? So you'll need to bifurcate this between an income based grant and a capital based grant. So let me just write it down. Income based grant. So if you want to repay an income based grant, secondly, capital based grant. So if it's an income based grant that you want to repay, what you need to do is, firstly you debit the repayment, to liability for deferred income, right? So you debit the repayment to liability. So you create, so if there is a repayment clause in the grant, what you need to create is, you need to create a liability that yes, 5 years, 10 years down the line, I'll have to make a repayment, and for that I'm making the liability right now only. If it's an income based grant, so you need to, suppose it's for your electricity bill every month and government gives you a certain amount free, right? And but government wants you to return that amount after the end of 10 years. So you create a liability and you debit the repayment to liability for deferred income. Yes, firstly. Secondly, for capital based grant, then two scenarios will arise. So two scenarios are going to arise. Firstly, if you've deducted it from the cost, right? So you can do two treatments to a capital based grants. We've already studied that. You can have two treatments, right? First is to deduct it. You've deducted the grant from the cost, or secondly, you've created a deferred income. Created a deferred income. Okay. So if you've deducted the grant from the cost, increase the cost of the asset. Very simple and very easy. Increase the cost of the asset. So you enhance the cost of the asset. But then there will be implications. Implications for what? That if you've charged the depreciation in the past, right? So it will also increase. This will result in an increase. It will again result in increase in depreciation charged in the past. So now what you do? So now what you do is, now what you need to do is, now you recognize. So now recognize and charge depreciation immediately, right? So now what you'll do is, whatever depreciation has not been charged, now you will charge it, because you're increasing the cost of the asset, so you need to charge that same depreciation as well. If you've created depreciation, if you've created a deferred income, right? So if you've created a deferred income, now debit, what you need to do is debit the repayment. Similarly, what we did in case of income grant, debit the repayment to any liability. So if you knew that after some time you'll have to pay the government, so you'll create a liability for deferred income, right? So you'll create a liability for deferred income, and any excess repayment. So if there is any excess repayment, suppose the repayment, government says we will also take an interest on this amount. So you not just pay us the amount of grant, you also pay us interest over it. So any excess payment shall be recognized. It shall be recognized in P&L, right? हाँ जी, समृद्धि समझ में आया बेटा? Got it? Great. Now comes the point of government assistance. So as we've set out in the definition of IAS 20, government assistance, what it does is it helps businesses by advising procurement policies, similar methods. It is not possible to place values, so they are not recognized. So government assistance are not recognized in the statement, in the financial statements. Got it? Now talking about something that we always talk about whenever we are studying an IFRS or an IAS is disclosure, right? So government grants having value will be recognized, but government grants which do not have any value will not be recognized in the financial statements. Now IAS 20 wants you to have the following disclosures. So what are the disclosures? As per IAS 20, following disclosures. So what all will be the disclosures? Firstly, accounting policy and presentation method. So accounting policy, so it gives you the choice of two policies. Accounting policies and presentation methods, right? So accounting policies and presentation methods, right? Secondly, nature of government grants. So what is the nature of the grants that you've recognized? You need to disclose if it's a revenue, if it's revenue grant, or it is for asset, or it is a non-financial assistance for the purpose of non-financial purposes. Nature of grant recognized in financial statements. Thirdly, what you need to tell them is any unfulfilled conditions. If you have not fulfilled any conditions, so any unfulfilled conditions for government grants recognized in financial statements. So that is it about government grants. हाँ जी, क्लियर है? तो ये तीन चीजें आपको डिस्क्लोज करनी पड़ेगी, राइट?